Here's how to trade the Canadian employment change in 3 steps. So step number one, you need to know the context. And one of the pieces of context is that the non-farm payrolls event and the Canadian employment report are released at the same time. So you don't want to trade US dollar pairs if you're looking to just trade Canadian employment, right? Because the non-farm payroll is going to overshadow everything else. So choose cross pairs or other pairs that have the CAD in them, pound CAD, that sort of thing. This is good. Okay, step one is you want to pair strength with strength and weakness with weakness. So what that means is a strong currency is going to look for excuses to continue to be strong. So what we want to do is use this data as an excuse to have that currency pair move even higher, or if it's a weak data point, to have that currency pair move even lower. So before you begin, find 2 pairs that you're going to trade depending on which way the news comes out. Now, we do this automatically for you at Financial Source with our macro snapshot indicator. But you can just do the research on your own. Okay, point number 2 is you want to trade the shock. And for this, we need to go to the charts. Trading the shock just means that currency pairs are going to move depending on how much the actual number deviates from what everyone expected. Now, here's the problem. Traditional free calendars like Forex Factory only give you one estimated number here for the employment change, 9.3 thousand, for example, and this is an average number. So it's basically impossible to tell what would be a shock for employment change or an employment rate. What you need is a professional calendar, which gives you the full range of expectations. And so what this is going to tell you is if something is released below the low or the actual release is above the high, that's going to be a shock. If it's in between this range, then it's not a shock. This is a range of all analysts and bank expectations. So if the employment change comes out between these two numbers, right, comes out between the minus 45K and the positive 35K, then it's not going to be a shock. You want something outside those numbers. Okay, then the third is what's the exact strategy? Well, the strategy is as soon as you see that there's a shock, and you can see this even faster with our lightning bolt feature here, which highlights if there's a shock immediately. Then you want to jump in on as soon as you see it, and preferably just before the 1-minute candle closes, right? Now, the idea behind the strategy is if it's truly a shock, the market should move in your direction within 5 minutes or so, and it should allow you to get into profit and move your stops to break even, right? If that doesn't happen, well, then maybe something's wrong. You know, how much of a shock was there really? And so that's essentially what you need to do. Jump in as soon as you see the shock, have your currencies paired. So you got strength and weakness. Then for taking profit, you can use support resistance. I like to use the options market. So you can go here to our implied volatility indicator, click on dollar CAD, find levels that the options market is saying, hey, this is probably an area of exhaustion or a turning point, and you can go from there.